Good morning, Dornbusch download number 41. 41. So what's that, 9 more weeks and we've cracked the half century.
Unbelievable. 2 more blood donations and I've cracked the half century.
I have to say, I really admire you. I see a needle and I just sort of crumple. How often do you give blood?
Every month.
Mate, that's a big
and
effort.
They hook me up for an hour. That's a bit of a worry, isn't it?
An hour?
An hour doing platelets, yeah.
Good on you, Dan. Great work. Andrew, Dan, Dornbush Partners. So, I've done no preparation for this week. I'm running around like a headless chicken. Thankfully, you're organised. So what are we talking about this week?
Whatever you want to talk about, Andrew.
Oh, good on you, Dan. On our little cheat sheet here, it says you're talking about Pulse Health Group.
Yeah, just one that came up, Pulse Health Group. Like we've been following Healthscope for a while now on Ramsay.
Yes.
And Pulse just came out of the blue. Share price about 52 cents. Just starting to pay dividends. Yields pretty low, 1.4%.
So what do they do?
They've got 8 private hospitals, Queensland and New South Wales. So it's more a specialty hospital, I suppose, targeted those higher income sort of...
More of a niche type of play.
More of a niche type thing. They just opened Gold Coast, so 6 theatres, 24 beds. But
6 theatres? Wow.
And it's really state of the art.
Okay.
So
that's really interesting. Because as you know, I've been looking at Ramsay the last few days, and I guess the appeal of Ramsay is that it's more overseas focused. It's
they just bought a chain in France.
Yeah, so they're heavy into France. Bonjour. Salut. And
Vin Rouge, s'il vous plaît.
Can I have the red wine? And they've also now got a joint venture going in China. So, if you're sort of looking for more of that overseas, I mean, it's a PE of 30. I'm not trying to tell you for a moment it's cheap, but the earnings growth is meant to be about 35%. But Pulse sounds interesting from more a domestic focus point of view.
More a domestic focus. I think too, maybe it could be a takeover target. They're talking that the companies are pretty cashed up now, aren't they?
Yeah.
If, say for argument's sake, Healthscope does sell its pathology unit, it'll be pretty cashed up as well then. So a lot of potential in that sector.
In fact, we're seeing a lot of companies, still sitting on cash. Interest rates remain low. We are starting to see a little bit more IPO activity, and we are starting to see a little bit more merger and acquisition activity as well. So maybe sort of Pulse fits into that.
Yeah.
Now, the other thing on your hit list is value and ETFs.
Yeah, well, the market's certainly come off, Andrew, hasn't it? So,
So what's an ETF?
An exchange-traded fund. So I suppose loosely it's a managed fund listed on the share market, sort of like a listed investment company. We like those ETFs where the physical stock are held. So code STW is over the ASX 200 and they hold the physical stock.
So you could buy STW. So in the past, and people still do it, nothing wrong with it, you could buy Argo or you could buy AFI, but they're sort of picking the shares in the basket. They're paying...
And they're investing in other LICs as well, aren't they? Listed investment companies.
So, and their management fees 0.2, 0.3% per annum.
Yep, similar fee structure with an ETF.
Or you could buy STW, and that is literally the basket. So the ASX 200, 40% banks, STW will be 40% banks. So if you want to track the index, instead of buying an Argo or an AFI, you'd buy STW. What's the dividends like?
Dividends is not too bad. It's around the 4%. I think it might be 80% franked.
Okay,
so,
all right.
Yeah.
Well, it might be an interesting
We've got to be getting into that zone, Andrew. We'll sell in May and go away. Seasonally, the buy time looks to be around that 3rd week of June. So
I was reading...
Next dip, maybe?
Yeah, I was reading the other day that 3 years ago there was about $2 billion in turnover in ETFs in Australia, significant sum of money. This year it's projected to be about 18 billion. And if you look at the US stock exchange, over half the trades done in any given day are in fact in ETFs.
And the good part about that is it puts volume into the market. I think we're seeing a lot of that from fund managers now, or from advisors, not specifically where we do shares, but advisors that in the past have done a lot of managed funds, and now that the trails are starting to dry up, they're looking at the ETFs as a better structure.
Okay, all right. So, and the other one, just briefly, we should talk about, and I know you spoke about this a couple of weeks ago, is around that Argo Infrastructure. So we're about to put in our bid for that, and that closes, I think, on the 26th of June, so we'll have a busy couple of weeks. But certainly the interest from all the clients I've mentioned it too has been pretty strong. You've had a fair bit of interest too.
Bit of interest there, It'd be interesting to see what that final yield is, though.
I think it's meant to be sort of 2-3%, so it's certainly not a huge spot from that point of view, as Dan's phone's ringing. And Susie's grabbing it. Thank you, Suze. But in the context of diversification, I think it looks interesting. And the figure the other day, $50 trillion worth of infrastructure required over the next 30 years.
Unbelievable.
That's huge. So certainly if you've got any interest in diversification, any interest in infrastructure, more of a growth play rather than a dividend
and from
play.
a proven manager too, Andrew, with Argo.
And
very
instead
solid.
of 14 infrastructure companies in Australia, you've got 300 plus globally. And of course, as we've been banging on about the last few months, that falling Aussie dollar, you should in fact be looking at companies that have more offshore earnings, with another appeal of Ramsay, CSL, etc., etc. That's why this Argo one might be worthwhile having a look at too.
Sounds good.
For no preparation, I think we've done pretty well.
Anything
else you want to cover off on?
No, payday tomorrow.
Happy days. Until next week.
Bye.